Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2023 October-November Paper 4-3 question number 1. This is the structured paper 4, which consists of 2 questions. Each of them will be of 25 marks, and the total time limit given for this paper is 1 hour, which means that ideally you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 1 under 30 minutes. So without any further delay, let's get started. Tea Limited manufactures a single product and uses absorption costing. The fixed budget and the actual results for the month of April are as follows. Okay, so our fixed budget, which is the standard units, is given to be of 2,000, but the actual units produced and sold was of 2,180. Then we're given the revenue, our direct materials, direct labor, as well as fixed overhead, and the final profit based on our standard values as well as the actual values. So this is a question for our variance analysis or standard costing. Now for the first part of this question, we need to prepare a flexible budget statement for the month of April. Okay, we have our statement for the fixed budget as well as the actual results. Now flexible budget will be made on the same format, but in this case all of our costs incorporated or the revenue will have our standard values, which is the budgeted values, and all of the number of units will be of the actual values, which just means that we need to transform the given sales revenue, given direct materials, direct labor, to represent the actual units of 2,180 rather than the fixed units of 2,000. So the first thing that we need to do is figure out the per unit revenue as well as the cost for direct material and direct labor. In order to do so, we can just divide the given values by the fixed budgeted units, which is of 2,000. Then we need those values such that it will reflect the actual results of 2,180. So within our flexible statement, we can just multiply the per unit value of revenue as well as cost to the actual units of 2,180 and create the budgeted statement and have our final budgeted profit. So let's start with our format. We can start with our sales revenue. So we have a total of 184,000. Now we need to divide it by 2,000 so that we get the per unit selling price. Then we need to multiply it by the actual units. So the calculation process is just going to be 184,000 divided by 2,000. This will give the standard selling price per unit. Then we multiply it by the actual units so that it gives the flexible sales revenue. That will be 200,560. The next step would be to calculate the direct labor and the direct material. So for direct materials we have 84,000 and for direct labor we have 60,000. So for labor we had 60,000. We divide it by 2,000 so that we get the standard direct labor cost per unit. Then we multiply it by the actual number of units. This will give our flexible direct labor value to be of 65,400. Then the direct material given was 84,000. We divide it by 2,000 so that we get the standard direct material per unit. Then we multiply it by the actual units. And this will give the flexible direct material cost to have the value of 91,560. Then we repeat the same process for the fixed overhead as well. And in this case, the given fixed overhead is of 18,000. Again, we need to transform it. So we first divide it by the standard units of 2,000. Then we multiply it by the actual units of 2,180, which results in the value of 19,620. And according to our format given above, we first calculate the total cost by adding the direct materials, direct labor, as well as the fixed overhead, and then figure out the profit. So let's repeat the same process here as well. We can calculate the total cost by adding these three values. So that will be 65,400 plus 91,560 plus 19,620, which results in 176,580. Now we can calculate our profit by subtracting this total cost from the revenue. So that's just going to be 200,560 minus 176,580, which results in a profit of 23,980. That is all for the first part of this question. Now, we need to calculate the following variances. The first one is for the sales price. So, as the name suggests, we will be comparing the actual price to our standard price. So, actual price minus the standard price. Then we just need to multiply it by the actual units. And remember, these are the selling prices per unit. So let's figure that out. For our actual price, we can just divide the total revenue by the actual units. So that will be 196,200 divided by 2,180, which results in a value of 90. Then for our standard price, we repeat the same process but use the given values for fixed budget. So the total revenue is 184,000. We divide it by the units of 2,000. This gives the selling price per unit of 92. Okay. So our actual price is 90, the standard price is 92, and the actual units was 2,180. And this gives the sales price variance of negative 4,360, and since this is negative, this will be adverse variance, and that's the case because the actual selling price is lower than what we anticipated, which means that the total revenue is also lower than what we hoped for. Now for the second part, we need to calculate the sales volume variance, but as a measure of change in profit. So again, in this case, we're talking about volume, so we will definitely be comparing the actual units to the standard units. But rather than multiplying it by the standard selling price per unit, since we are trying to figure it out as a measure of change in profit, we will be multiplying it by standard profit per unit. Okay, so let's calculate the standard profit. The format is same, we just divide the standard profit by the units. That's the standard unit of 2,000. And this gives the standard profit to be of 11. Okay, and in this case, the actual units given is of 2,180. The standard unit was of 2,000. Then our standard profit is 11. This gives a positive value of 1,980, and since this is positive, this will be a favorable variance. That is also the case because our actual units sold is greater than what we anticipated for. So our total sales value will be higher. Then we have the fixed overhead expenditure. So this is quite simple. We just need to compare the standard fixed overhead to the actual fixed overhead. And both of these values are given in the statements above. So for the standard fixed overhead, we have 18,000 and the actual one is 18,400. So 18,000 minus 18,400, which means that this will give a negative value of 400. And since this is negative, this will be an adverse variance. And that's also the case because we only hoped for our fixed overhead to be of 18,000, but in reality, we had to pay the fixed overhead of 18,400, which is higher than what we anticipated for. So that's a negative factor because we do not want our cost to be higher than what we hoped for. Then we have our fixed overhead volume. And fixed overhead volume variance is similar to that of fixed overhead expenditure variance, but in this case, rather than comparing the standard fixed overhead to the actual fixed overhead, we will be comparing it to our flexible fixed overhead. So the formula is just the comparison between the flexible fixed overhead and the standard fixed overhead. And for the flexible fixed overhead, we can just refer to the value from our flexible statement right here. That's of 19,620. So 19,620, and for our actual, for our standard value, it was of 18,000. This results in the positive value of 1,620, which means that this will be our favorable variance. And this concludes the second part of this question. Let's move towards the third one. We now need to prepare a statement to reconcile the flexible budgeted profit as calculated in part A with the actual profit. And our statement should start with the flexible budgeted profit. Okay, so let's start with flexible budgeted profit. This we've already calculated in the first part. That's 23,980. And remember, whenever we prepare a statement to reconcile the flexible budgeted profit to our actual profit, the variances that we need to adjust will be our sales price variance, the total direct materials variance, the total direct labor variance, and the total fixed overhead variance, which is just the sum of the fixed overhead expenditure variance and fixed overhead volume variance, which we have already calculated in part B. And the sales price variance is also calculated in part B. Now, in order to calculate the direct materials variance and direct labor variance, we can just compare the flexible values to our actual values. And as for the adjustment, if the variance is of adverse condition, then we need to subtract it from our flexible budgeted profit. And if the variance is of a favorable condition, then we need to add it. So let's start with our sales price variance. That's already calculated right here. So that's 4,360, and this was of adverse, which means that we need to subtract it. So 4,360 will be subtracted. Now let's move towards the direct labor variance. And for this one, we can just figure out the difference between the direct labor for our flexible budget and the actual direct labor given right here. So our flexible value is of 65,400 and the actual value is 55,590. So that's just going to be 65,400 minus 55,590, which results in the value of positive 9,810, which is a favorable condition, so we just add it. Then we move towards the direct material variance. And we repeat the same thing for material variance as well. So our flexible value is 91,560 and the actual value is 113,796. So that's 91,560 minus 113,796, which results in a negative value of 22,236, which means that this is of adverse condition. And for both of these, the explanation is quite simple because these are the values that we budgeted for the actual number of units, right? But these are the actual cost for the direct labor as well as direct material variance. And in case of direct labor variance, we can see that it's a favorable condition because in reality we had to pay lower as compared to what we anticipated for. But the opposite is true for our direct material variance because we hoped for only 91,560, but we actually had to pay for 113,796. So our cost was higher than what we hoped for, which results in an adverse condition that's subtracted from our flexible budgeted profit. Now we need to make adjustment for our fixed overhead variances. So the first one is going to be our fixed overhead expenditure variance. And the second one will be fixed overhead volume variance. And the sum of these two will give the total fixed overhead variance. So for our expenditure variance, we have 400 adverse, we will be subtracting that. And for our volume variance, we have 1,620 favorable, so we'll be adding that. All right, and now the sum of all of these values should give our actual profit. So that's going to be 23,980 minus 4,360 plus 9,810 minus 22,236 minus 400 plus 1,620, which results in the value of 8,414. And we can also verify this from the given information itself because we were given the actual profit. That's also 8,414, which means that our calculation for variances were correct, as well as the adjustment process is also correct. So this completes the third part of this question. Let's move towards the next one. We now have additional information. An analysis of direct material variance shows that both the material price and the material uses have an adverse variance. Okay. And the directors of Tea Limited are considering changing the existing supplier. They have two potential suppliers to consider. So we have local supplier A and overseas supplier B. And the uses per unit after wastage for the materials from supplier A is 2.8 kilos and for material from supplier B is 2.5 kilos. And the purchase price per kilo quoted by the supplier is also given. So the price is lower for supplier A, which is a local supplier, as compared to the overseas supplier. Now we need to advise the directors which supplier they should choose. We also need to justify our answer and support it with relevant calculations. So the first thing that we can calculate would be the unit cost for both supplier. So for local supplier A as well as overseas supplier B, the first thing that we can calculate is the unit cost, because we have the kilos required, so that's the uses per unit. And in order to calculate the unit cost, we just need to multiply it by the price per kilo, which is also given right here. So for local supplier A, that will be 2.8 times 13.75, which results in the value of 38.5. We now repeat the same process for overseas supplier B. So that's 2.5 multiplied by 15.4, which again results in 38.5. Now let us also calculate the unit cost for our budgeted values and the actual values. Okay, now for our budgeted values, we're talking about direct materials. So we can just divide this 84,000 by the budgeted units of 2,000. So that's 84,000 divided by 2,000, which results in 42. That's the budgeted cost per unit for our direct material. Then we repeat the same process for our actual values. So we can see that the actual direct material is 113,796. And in order to calculate it per unit, we can just divide it by 2,180, which results in the value of 52.20. Okay, so the very first observation that we can make is that the unit cost for both the suppliers is the same. Then the next observation that we can make is that the unit cost quoted by these suppliers will be lower than our budgeted cost as well as the actual cost. So the unit cost of 38.5 quoted by either supplier is lower than the budgeted cost and the actual cost. Okay, that is all for our financial factors or the relevant calculations, and this is of 7 marks, so we need to have at least 4 more non-financial considerations and then one final decision. Okay, the next thing that we can comment on would be the quality of the materials. And in this case, the quality can be determined by the uses per unit after wastage. So lower the uses, it means that we can produce a unit by consuming lower materials. So that increases efficiency. And in this case, we can see that the lower uses per unit is for the material supplied by overseas supplier B, which means that the quality of materials from supplier B is better than from the supplier A, and that is because of less wastage. Let's write it down. The quality of materials from supplier B is better than from A because of less wastage. Then we can also compare the unit price per kilo, and in this case we can clearly see that the price per kilo is lower for our local supplier A. So the unit purchase price of supplier A is lower than B. And another important factor to be considered is that supplier B is overseas, whereas supplier A is a local supplier. So the difference in this case is that the additional cost might be incurred for supplier B, and these additional costs might include import duties as well as insurance charges. So additional costs such as import duties and insurance might be incurred for supplier B. Okay, now based on these factors, we need to make a final decision. And personally, I would suggest the directors to choose supplier A because first and foremost thing, they are a local supplier, right? Which means that if there's an urgent new customer, then we can make prompt delivery from these suppliers, but that might not be the case for our overseas supplier B. And another reason for this is that additional costs might be incurred for supplier B, which will make the purchase price per kilo even higher than what it is currently. So that's the basis for my decision. The directors should choose supplier A as prompt delivery is possible due to them being local, but the same cannot be said for supplier B. Alright, that's all for this question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.